Good evening, everyone. Can you hear me clearly? And also, can you see my screen?
Yeah,
Yeah, I request all of you to please be on mute as there are multiple participants who are going to join. So you can use the chat box if required. I'll just mute all of you. Yeah. So let's begin with our session for the day. The topic for the day, as you know, and you can see on your screen as well, is accounting for developers and IT professionals. So I believe most of you are working in some kind of fintech companies wherein who provide applications for banks or corporates. And in any industry, you may be providing applications. Any industry is incomplete without the accounting part of it. Every transaction that you do, every money you receive, or every money you pay has some linkage with the accounting of part of it. So that's why we decided to have a focused discussion on accounting. So before actually going to the topic, let me just take a couple of minutes to introduce MVLco. MVLco, that is MVL Consulting Private Limited, was founded in 1996, and since then it has been a leading service provider in consulting, assurance, and training services. Its main focus is BFSI domain, that is banking and finance. And in this BFSI domain, MVLco does a lot of consulting, software and application testing. It also conducts information security audits and obviously provides trainings to various banks as well as IT companies. And many of you have already been part of the MVLco trainings and MVLco certification courses. So you may be aware that MVLco certification as far as payments, cards, messaging and trade finance are concerned, they are widely accepted by a lot of IT companies. So moving on, let's understand what is our agenda for the day. First of all, we are going to understand what is the need of accounting. After that, we are going to go through the key accounting concepts and principles. So they are going to tell us how a transaction should be accounted for. Then we will also understand what are the golden rules of accounting. So there are 3 golden rules of accounting, which will help you to decide how a transaction should be accounted for. So the second and third point will let you know how a transaction should be analyzed and accounted for. And then the next 2 points, that is the journal, ledger, sub-ledger, P&L, that is profit and loss statement or balance sheet, cash flow statement, etc. They actually summarize those transactions, and you would have heard a term called financial reporting. So you summarize, analyze those transactions and then report it to someone. So that part would be through the P&L, balance sheet and cash flow statement. Then apart from that, we are going to see a concept of clearing, parking, suspense and wash accounts. So they are different from the traditional accounts, but they are quite often used in day-to-day practice as far as various softwares are concerned. So that's why we are also going to discuss that. So let's start one by one. Let us understand why account for a transaction, and before that, let us understand what does really accounting mean. So as the definition says, it means a systematic and comprehensive recording of financial transactions. So a focus is invited. We are saying these are all financial transactions. So it means that we are going to record only those transactions which have some kind of a financial impact. Transactions which do not have any financial impact are not going to get recorded as far as accounting is concerned. For example, an employee joins a company. At this point of time, on day 0, when an employee joins, there is not going to be any financial impact. So there is no accounting that is going to happen in my books of account. Obviously, there would be entry in my, say, employee master, but as far as my accounting records are concerned, there is not going to be any entry. However, when after a month, when an employee gets salary, that's where I have financial impact, and that is where my accounting is going to get attracted. So that is why we say that it is recording of financial transactions. Now, once you record, after a period, say a month, a quarter, or a year, you summarize them, analyze them, and report those historical transactions. So one is go on accounting till the end of period. At the end of the period, summarize them, analyze them, and report them. Also, another word we need to focus on is historical transactions. So as far as accounting is concerned, I can say it is a post-mortem. which means that a transaction has already happened, after which you go on accounting. All right. So that's why we say that accounting pertains to historical transactions, something which has already happened. Now, why do we actually account for those transactions, and why you would have seen every company or every organization has its own accounting team, or it outsources the job of accounting, but then everybody does this accounting. Why do we do it? So the first and foremost reason obviously is to track my transactions. Where am I getting money from? Where is the money going? So that is the first and foremost reason. Obviously, if I record all those transactions, only then I'll be able to compute what is the profit or what is the loss. How will I come to know about it? I will record all my incomes on one side. I will record all my expenses on other side. And if I net them off, I will understand whether I have made a profit or loss. Apart from that, if a business wants to understand what are its assets and what are its liabilities. So when I say assets, what does it actually mean? An asset would mean any resource from which a future benefit is expected to the organization and which is controlled by the organization. So a simple example would mean your building or your intellectual property rights, your laptops, furniture, and so on. So these are all resources which are going to give benefit to that company for a longer period of time, maybe a more than a year. Now, there could be some assets like, say, your stock or cash. Now, you do not intend to hold your inventory for a long period of time, right? But then it is still going to give you benefit in your future period. So those resources are also called as assets. Now, going back to definition where we said that we are going to record only financial transactions, right? So from IT company's perspective, one may say that the manpower is the biggest asset for any company. But then as we said that, and we are also going to understand one concept called money measurement concept, unless we are able to measure that asset in terms of money, we cannot recognize that in books of accounts. So a company may have a huge talent pool. It may have very good human resource, but as of now, the way accounting goes across the globe, such kinds of assets are not recognized in books of accounts. On the other hand, you have liabilities. What would a liability mean? Liability is something wherein a business will have to give away some part of money, right? Something which is owed by the business, something which is payable by a business. So maybe a loan taken from a bank can be one liability. Maybe I have purchased the goods for a credit period of 30 days. So then for those 30 days, my payable to that supplier would become my liability, and so on. So if I want to understand at any given point of time what all are my assets and what all are my liabilities, then the only way is to account for all those transactions. The third aspect is understanding cash flows. So where is actually cash coming from? Where is it actually going to? And analyzing them and classifying them into multiple aspects, like what is my cash generation from my basic operations, then where all have I invested my money, and so on. So we are going to also understand what is a cash flow statement. There you will get more clarity. Now all this 1 to 4 points, you may believe that these are for owner of a business, but then you also need to consider that there are many other agencies or other stakeholders who would be interested in your accounts. Something like maybe your bank from which you have taken a loan. Now bank will have to assess your credit worthiness, and an important tool for assessing your credit worthiness would be your financial statements. Government. Now government wants to check whether you have paid the taxes correctly or not, and what is your overall economic progress. So in that case, government is also interested in knowing how your financials look like. So it is not only the owners of the company who want to understand your accounting statements, but there are external stakeholders like banks, governments, or your investors who would also want to understand what your company is actually doing. Also, when we are talking of a company, you may be aware that every shareholder is actually owner of that company. Now maybe I may be holding shares of Infosys. Now it does not mean that I am anyway related to Infosys operations, or I do not know what are the orders with Infosys, or what are the costs involved in Infosys. But then if I have still bought a share of Infosys, which means I am part owner of that company. So as an owner, I have that right to understand what is the company's performance. And that's why you see listed companies have to give away or declare their financial results and give their financial statements to public. You can go to their any listed company's website, and you would find something like investor relations, wherein you are able to get financial statements of a company. Or you can simply go to some sites like Money Control and find out accounting statements of listed companies. What is the purpose of these? Is that I, as an investor, would want to know that where my money is going, how that company is performing. So that's why there is one more thing that comes into picture. Now, whenever these external parties are analyzing, they are analyzing multiple parties at single point of time. So as an investor, maybe I can say that I have invested in Infosys. I also have invested in company like TCS. Now, if I were to compare results of both of them, there has to be some way by which I can measure them. There has to be some standardized platform over which I can measure them. So basically, accounting provides you with this tool that both of them would be accounting using same set of principles. Both of them would be giving you results in the same kind of a format. And now I can simply pick up their profit and loss statement. I can simply pick up their cash flow statement and balance sheet, and I can go on comparing them. So that's why we say that it is going to be systematic and comprehensive recording, and thereafter it would be summarized for analysis. And what is it? The analysis what I am talking of is basically the performance of the business, where all money is coming in, what is the profitability, what is the return on my investment, and so on, for which I am going to use my financial statements. And as I said, wherever public interest is involved, so there are multiple investors in case of a listed company, wherein a government would itself say that you have to disclose your financial statement, something what we call as a financial reporting, that you prepare your statements, close your statements on a quarterly basis, and disclose it to public, what is your performance. So one is, as an owner, I may be interested in understanding my own business performance. There could be some other parties like banks who would be interested in knowing my performance, or simply because there is a regulatory requirement, I have to maintain my books of accounts. So because of all these reasons, every organization in some way or the other tries to maintain its books of accounts. And that is why you would find the accounting to be universal. So let us understand some key accounting concepts or principles. Now I am going to give the concepts in some logical way so that it becomes easier for you to understand. You may not remember name of that concept, but what you need to focus on is the crux of that concept. And I am going to use some examples to which you can relate so that it will be easier for you to understand. So let's go to our first concept. Now what you see on your screen is a famous scene from a famous Bollywood movie many of you would already be aware of, wherein there are two heroes on your screen trying to compare who has more wealth. On one side, one actor says that I have a car, a bungalow, and money. On the other side, the hero says that I have my mother with me. So keeping aside emotions for a moment, the key questions that they are trying to answer is who has more wealth. And so can you really compare? The answer is no. And that's what takes us to money measurement concept. What money measurement concept says is that transactions are always accounted in terms of money, is first part. And second, transactions which can be measured in terms of money are only accounted for. As I said in my initial discussion as well, is that something which you cannot account for in terms of money, you cannot record that transaction. Like I said, a new employee joining, there is no, one may say that my assets have increased because I have one more talented employee, but can you really measure it in terms of money? The answer is no. And that is why such transactions are not accounted for. That's the first concept called as money measurement concept. Now we have a second concept, wherein again on your screen you see Mukesh Ambani, who has invested in shares of Reliance. So he is the owner of Reliance, and as far as regulations are concerned, the regulation itself says that any company, here we have taken case of Reliance, is a separate artificial person. So Mukesh Ambani is a different person and the company is different person by law itself. This is as far as our Indian Companies Act is concerned, or those organizations which are in status of company or banks are concerned. Now we have one more example wherein a Billu barber is there and he has his own shop, and you would have also seen that there are many sole proprietors. So they have their own shop. The business form or business status is not in the nature of company, it's proprietorship. Legally speaking, the owner and its shop is one and the same as far as legal status is concerned. But when it is about accounting, accounting says that you need to distinguish your owner from the business. So if in our case, say Billu gets cash gift from SRK, will you really account for it? The answer would be no. And the basis for it would be business entity concept. This concept says that business enterprise is a separate entity from its owners. Only business transactions are accounted for in business accounts and personal transactions of owners are not accounted for. This leads to one more logic. So let's say I start a business and I introduce my capital. Now, based on this business entity concept, what I would say is that I have given away this money to my business. So from business's perspective, business has to return me this money. And we said that anything which needs to be returned or paid by the business is a liability. So that's why even owner's capital becomes a liability for a business. Similarly, let's say a business does its operation for a year. At the end of the year, it identifies that it has made some level of profit. Now again, this profit is payable to the owner. The profit also becomes a liability for the business. Why? Because it is payable to the owner and owner is treated as different from the business itself. On the other hand, let's say if business has made a loss, now it would say that owner has actually operated the business and now owner should repay this amount to the business. So I would say that if a loss is made by a business, then business would call it as an asset. Very strange to hear this, but this is how accounting would work. That if it's a profit, it eventually becomes a liability because it is payable to the owner. Whereas if it's a loss, it eventually becomes asset because it is recoverable from the owner. And this is because business entity concept is there. Now, if we are saying that business is altogether a separate entity from its natural person owner, then the next question that comes to our mind is that then what is the lifespan of these companies? So that's where we get our next concept, which says that a business enterprise is assumed to continue its operations for foreseeable future unless circumstances exist otherwise. So let's say if I were to take a case, I would say that can anybody tell that whether Apple Inc. will close down in next 5 years? Nobody will be able to answer that at this point of time. Or if I were to say, when will Apple stop its operation? Nobody would be able to give any specific answer. Why? Because it is assumed and it is expected that business will continue forever. The owner may change, the natural person or the owner may die, a new owner may come up, but because the business is a separate legal entity, it will continue forever. However, it gives you one more exception. It says that unless circumstances exist otherwise. If we were to discuss the same about, let's say, someone like Jet Airways, wherein we know that Jet Airways has a lot of issues and it's possible that in near future Jet Airways may actually be liquidated and may close down its business. So unless there are specific circumstances that indicate that a business may not continue, from accounting perspective, it is always assumed that business will be there forever. Now, what is the significance of this concept? Here I have just mentioned one point and I will explain this again when we go to one more concept. It basically affects valuation of assets. As per our regular or conventional accounting, all the assets are generally valued at historical cost. So the cost at which I actually bought my asset. For example, as a company, if I bought my building, let's say at 500 crores, all right, today its market value could be say 700 crores. Even though the market value has increased, in my balance sheet, when I say that I own a property or when I own a building, I will still show that at 500 crores. Assuming my company is expected to exist for a long run, that is, It is assumed to continue forever. On the other hand, if I'm saying that I'm going to close down my business, in that case, in my balance sheet, I'm going to value this asset, my property, at 700 crores. Why? Because now this is the expected gain which I'm expecting in a short period of time. I'm going to close down my business, I'm going to sell my assets, and what is the value that I expect at this point of time is 700 crores. And that's why I would be reporting these values at fair value. Now, there is one more note that everybody needs to focus on, is that as far as banking is concerned, or even as far as companies are concerned, there are various accounting standards or regulatory provisions which ask certain kinds of assets or liabilities to be valued at fair value only. It depends on regulatory requirements and accounting standards applicable in each geography. Now, certain assets like your receivables or payables, many countries tell you that they have to be accounted for fair value only and not at the historical cost. So while going concern concept is there, the accounting standard, or you may have heard a term called GAAP, GAAP, which is generally accepted accounting principles. Now they may tell you that certain kinds of assets have to be valued at fair value only. That's where you are taking a sort of exception from this going concern concept. Okay, so now as a going concern concept, I understood that my business is going to be there forever. So then when should I actually close my accounts and review my performance? That is the next question. For that, periodicity concept says that for measuring performance, workable fraction of time could be a month, could be a quarter, half year, a year, anything, whatever is suitable to the owners, can be chosen, after which your accounts would be closed and your performance would be reviewed. Now, while accounting does not say what fraction of time, that is, what period of time should be considered for closure of accounts, your regulations may specify duration and dates to be considered. So, what you see on your screen as of now is an extract from Indian Companies Act, and similar kinds of provision also apply to banks as well, which says that your accounts have to be for a financial year. And when you say a financial year, it means period ending on 31st day of March. So with this provision, every company is required to close its account at least per year. There are certain exceptions which I am not discussing at this point of time, but in most of the cases, the company needs to close its books of accounts on 31st March of every year and review its performance. Now those companies which are listed, as I said, there is another regulation which comes from Securities Exchange Board of India, SEBI, which says that you have to close your accounts on a quarterly basis and disclose it to the investors. Now you can have some regulations like that. Alternatively, now what you see on your screen has been actually taken from financial statements of Apple. Just focus on the first line. Company's fiscal year is the 52 or 53 week period that ends on last Saturday of September. And on the last line you can see company's fiscal years 2016 and 2015 ended on 24th September and 26th September respectively. So in this case, the local regulations give this liberty that you can choose your own period and you just need to disclose what is the period that has been considered. So it can be either regulated by the regulations or accounting standard, or it may be kept to the liberty of owners. So the idea of this is that you take a pause at after a certain period of time, summarize your transactions and then analyze them. This is as per periodicity concept. Now, the next question that would come is that if I am going to break this accounting cycle after a certain period of time, can I have different policies which I can adopt for each period or for every year? Now, one more thing to note here is that we are discussing this accounting concepts and principles, and we are also going to discuss about the golden rules of accounting. Plus, we said that there are various accounting standards or regulatory requirements. Still, accounting still has some kind of a flexibility. There is a scope for a lot of estimation, there is a scope for a lot of assumptions. A single kind of a transaction may be reported in multiple ways within the framework which has been given to the company by accounting standards. So company has its own right to choose various accounting policies. The only requirement is that all those policies have to be disclosed properly. Coming back to the question, that if I am given this choice that I can choose my policies, then can I go on changing these policies? The answer is no. That's where the next concept comes in, which is called as consistency concept. It says that your accounting policies, at year one, you can decide whatever you want. But once you decide, they have to be consistent across the year so that I can compare the performance. Because if I change my accounting policy, the results could be different, and that is why the result in one year may not be comparable to result of another year. That is why I should be consistent across all the years. However, it gives you one exception. It says the policies can actually be changed in exceptional scenarios. And when can I actually change those policies? Where the revised policies lead to better financial reporting. So whatever I had adopted so far, I have found out some better way of accounting a transaction, and that is why I would now change the policy. I will have to disclose, and when I disclose, I also need to disclose what could be the change in the result. So for example, if I have changed the policy because of which profit has increased by say 5%, then I will have to clearly disclose in my accounting statement that so and so policy has been changed, because of which my profit has increased by 5%. So anybody who is actually trying to compare will understand that had the company adopted the old policies, then the profit would have been lesser by 5%. That's how the disclosure is required to be made. That's as far as consistency concept is concerned. The next concept, again, I will take one example. On left side of your screen, you have BSNL, who generally gives you postpaid connections. So what happens in postpaid connection is that, let's say a phone is used in March, bill gets generated after end of the month, and amount is actually collected in April. On the other hand, you have someone like Jio who offers you a prepaid connection. Now, first you have to make payment. So let's say amount is paid in March, that is Jio receives the amount in March, and now I am going to use this phone from April to June. So amount and usage are in different financial years. That is the key point that I am trying to emphasize here on. So then when should these companies actually account for income? That's where our accrual concept comes into the picture. What accrual concept says is that transactions are recorded in the period to which they pertain and not in the period when cash or money is actually received. So what I am trying to say is that let's take a case of BSNL. Now the usage of phone or delivery of services has actually happened in the month of March itself. So at the end of March, BSNL has actually received the right to recover money from the customer because it has completed its part of obligation. So once BSNL has actually received this right to recover, it can say that, okay, I have actually earned my money. Whether cash is actually received, the answer is no. But whether the right to receive has been attained, the answer is yes. So as far as BSNL is concerned, it will account as income in the month of March, and it will account it saying that amount is receivable from my customer. In April, when customer actually pays the money, it will simply say that I had receivable from my customer, now I have received the money and there are no more receivables. So my receivables now got converted into actual cash. But as far as income is concerned, income would be booked in the month of March itself. Similarly, in case of Jio, amount is received in the month of March, but then has Jio actually earned that money? Has it actually received or earned the right to collect that money? The answer is no. So when Jio receives this prepaid connection amount, it will say that I have received this money and the services are yet to be given. So this is a sort of liability for me. I'm liable to provide services against this amount of money. So whatever amount is received, it is shown as advance received, repayable to the customer in terms of service. So I would not account for it as an income. I would record receipt of money saying that it is my liability, and after the month of June, I will say that now I have provided all my services and now I am eligible to collect this money, or I have now received the right to collect this money, and that is why Jio can now account that money as income. So it will reduce its liability and increase its income. Now all this transaction is as per accrual concept, wherein we are saying that transaction would be recorded in the period to it actually pertains and not based on whether when was cash or money was actually paid. So you would have heard words like provision of expenses. So what would a provision of expenses mean? Is that I account for expenses in which expenses were actually incurred, not when they were actually paid. A simple example could be your telephone bill or your electricity bill. So you use, say, electricity on day-to-day basis. Bill gets generated after every 2 months. After you get a bill, you still have some due date within which you can make a payment. So from company standpoint, let's say you have actually used electricity in February and March, but then you will receive this bill in the month of April and you will make payment maybe in month of May. However, you have actually incurred or used that electricity in the month of February and March itself. So as per this accrual concept, you will have to account for those expenses in those months itself and not in April or May when you are actually going to make a payment. So that is why, so when you have not paid it, you will have to show that as a liability, and accounting terminology for the same is a provision for expenses. So you anticipate what would be your expenses even though you have not received a bill from electricity company. You account for those expenses on estimate. Now, whenever the actual bill from electricity company would come, you recognize or you account for the difference in what you had estimated versus what is the actual. That's how this accrual concept works. If there are few individuals, or as per the taxation law, some organizations are allowed to maintain their books on cash concept, wherein you would record for transaction only when cash is received or paid. But that is not really something which is globally accepted and not at all used by big companies. They are mandatorily required to use accrual concept only. Fine. Now let's come to next concept, and you can see words like debit and credit. First, let us focus on the leftmost column of this table. So you have a group of accounts wherein it says assets. We have already discussed what an asset would mean. An asset is any resource which is expected to give any future benefit. Technically speaking, should the asset be owned by the company? The answer is no. If company has control over that asset, from accounting perspective, it is good enough that you can still account for that transaction as an asset. Now, what could be example? Now, you may have heard concept like a company gets a land for a lease period of 99 years. Now, when I use the word lease, it means that ownership is not transferred to the company. But in a sense, when I say 99 years of lease, would mean that in a way the company actually has a right to control the land for next 99 years, which is a very big period. So while legally company does not own that land, it has all those rights which an owner would ordinarily have, right? So in that case, in such cases, the company may actually account for the transaction and say that this land is my asset. Why? Because I can control it for next 99 years. So there could be certain examples wherein the asset or the resource may not actually be owned by the company, but if it has all those rights which an owner would have, it can still account for that transaction as an asset. Next is the liabilities. We also discussed what would a liability mean. Anything which is payable. Now, one may classify owner's equity separately. While owner's equity is a part of liabilities, it is required to be disclosed separately. So something which is repayable to the owner. However, as you can see here, I will explain this, but anyway, if you can see here, its behavior is same as any other liability. Then you have revenue, what we call in simple terms as any kind of income, that is nothing but your revenue. And then you have expenses, so any kind of expenditure that you make. So you would have heard terms debit and credit. So let us understand where do they come from. So there is a concept called dual aspect concept, which says that every transaction will have two effects, a debit and a credit. This is also called as double entry system of accounting. So any transaction will have a debit effect as well as a credit effect. And how and which accounts to be debited and which accounts to be credited, we will discuss that later. But at this point of time, let us understand that every transaction has to have some debit effect and some credit effect. It is a must. It is a mandatory thing. Now, there may be a possibility that multiple accounts are getting debited and multiple accounts are getting credited. However, what one needs to ensure is that total of debit amounts and total of credit amounts has to match with each other. So in any transaction, the amount of debits and amount of credits has to be equal. We will understand this better using an example in our subsequent slides. But at this point of time, we need to understand that always there would be one debit effect, or there could be multiple debit effects and there could be multiple credit effects. And when we say debit or credit, what does it actually mean? So now we can go to the table below. If you are debiting any asset account, it means you are actually increasing the value of that asset. In other words, let's say I have received money in my bank account. Then in my books, I will debit my bank account. What does it mean? I am increasing balance in my bank account. Now there could be a confusion that when you receive money in your bank account, your bank says that your account has been credited. Now you need to understand that bank is sending message from its own set of books, right? So if bank has received money on your behalf, bank has to actually pay that amount to you, right? So from bank's perspective, it is actually a liability. Bank has to pay that money to you. And if you see the liabilities portion side, when you credit the liability account, it means the value of that liability has actually increased. That is why when bank sends you a message, it says that your account was credited when you received the money. Excuse me. Alternatively, when you say withdraw a cash or when you swipe a card, your bank says that your account was debited. Means in bank's book, the liability was reduced. And that is why it has debited your account. If you were to account for your own transaction in your own books, you would say that my bank account balance has gone down, and that is why you would be crediting your bank account. Alright, so that is the way to understand this. So similarly, if you are going to get some kind of income, is going to increase, you need to credit the revenue account. Alternatively, if you have an expense, you need to debit the expense account. How do we actually do it? We will understand in an example. But this is a key table which can help you to understand what really happens or what does it actually mean when you debit or credit any type of an account. Alright, so let's move forward. Now let's come to the next concept. So here what you see on your screen is don't celebrate before you win. That's the exact concept which is given in accounts as well. It is called as conservatism concept. It says that do not account for any kind of anticipated gains. So if you anticipate any gains, till you actually realize those gains, do not account for it. However, be conservative. If you believe that there are going to be certain losses, account for it today itself. So that is the conservatism concept. If you have any anticipated gains, do not account for it until you actually realize those gains. Whereas if you see any potential losses, then you need to account for those potential losses on day one itself. Alright. Now this is in line with the cost concept. We also discussed this when we were discussing going concern concept, where we said that we will record a transaction at cost itself. Now the same is also given by realization concept. So I'm not repeating. It means the same thing is that if you have any anticipated gains, do not account for it unless they are realized. However, there could be certain regulatory exceptions. Let me explain how it happens as per the conservatism concept. Let's say I have invested in shares of Infosys. When I bought those shares, say share price was 500 rupees per share. Today, at the end of the day, I understand that Infosys shares price has actually moved up to 550. I bought it at 500 and it has moved up to 550. But I have not sold the share. I simply know that price has moved up. So then as per conservatism concept, am I allowed to book this profit of 50 rupees? The answer is no. I cannot book this. If I actually sell the share and realize that gain of 50 rupees, yes, then I can account for this profit. Otherwise, I cannot account for this profit. However, on the other hand, let's say if Infosys share price actually drops to 470 rupees. I had bought it at 500, but now the price has gone down to 470. So I have a potential loss of 30 rupees already. In this case, accounting says that you account for this 30 rupees loss immediately, even though you have not realized it. Based on conservatism concept, you need to account for it immediately. That's how a conservatism concept would usually work. However, as I said, there are certain regulatory exceptions. So MTM here means marked to market. So what does mark to market would mean? So a bank or any company would be doing a lot of transactions on say stock exchange or with other banks. Something like buy and sell of foreign exchange. You may have also heard of terms like derivatives, wherein they may enter into contracts of futures, options, forwards, and so on. In these kinds of scenarios, or those investments for which the bank has bought those investments for the purpose of profit, it is allowed, or rather it is required, that you actually value those investments at market only. That is, if there are any gains, even though not realized, you may account for that, and if there are any losses, you have to account for that anyway, as per conservatism concept. So if there are certain kinds of investments or certain kinds of contracts wherein MTM, that is marked to market, is applicable, then this conservatism concept is not actually applied. In that case, you may actually account for those gains even if you have not realized them. Even if they are simply anticipated, you can actually account for it. I'll give you one example to understand this. Let's say I have exported goods today. I exported goods worth say $1,000. Today, assume that rate of dollars against rupees is that for $1, I will be able to get 65 rupees. Let's say on accounting closure date, let's say on next 31st March, I have still not received that money from my customer. In my books of accounts, I am showing those $1,000 as receivable. On 31st March, the dollar rate has actually moved up to let's say 67 per dollar. Now there is an anticipated gain of 2 rupees per dollar. So in this case, ideally, as per conservatism concept, I should not have accounted for this anticipated gain. But because this specific accounting standard, which talks about foreign exchange transactions, says that in case of foreign exchange receivables or payables, I need to record or value the amount at the mark to market, that is the market rate. So for 31st March closing, I will revalue my receivables from 65,000 rupees to 67,000 rupees, considering that dollar rate has actually moved up from 65 to 67. I will account for the additional 2,000 as my income, even though I have actually not realized or I have not actually received those many dollars. That's how this exception would work. Okay, so let's move to the next section, which is golden rules of accounting. So whatever we discussed so far was the base of accounting. Now let us understand what are the golden rules of accounting. So before we actually understand what are those rules, because these rules change based on type of account. While they are very simple, let us understand what are these different types of accounts. So on one side, you have personal accounts, right? Now what you see here, debit the receiver, credit the giver, is actually a golden rule. But before that, let us understand what a personal account would mean. In simple terms, any account which represents any natural person or artificial person, any individual, would be classified as a personal account. So let's say a company has accounts of its employees, its customers, its suppliers. From say bank's perspective, it has multiple saving accounts, and then your fixed deposits. On loan side, I would have given car loan, maybe home loan. All of them actually represent that borrower or that investor. All those accounts are classified under personal account. So they represent either individually or collectively a group of persons. Now when I say person, it could be a natural person, someone like you and me, or it could be artificial person, a person which is created by law. Companies, while it's not a natural person, still it has a separate status as far as law is concerned. So even those accounts are called as my personal accounts. So now personal account may actually have name of that person. I may say that I have account in name of say Sachin. At the same time, I may collectively say that I have accounts of my customers. So I'm not naming it to a specific person, but I'm collectively calling them as customers. In both the cases, it is classified as personal account. Now, whenever you are dealing with a personal account, the rule is that you need to debit the receiver. So, whosoever is the receiver of that money, his account should be debited, and whosoever is the giver of that money, his account would be credited. And we will understand this again based on our example on our subsequent slide. So, the first golden rule is debit the receiver, credit the giver. Next type of account is a real account. Now, when we say real account, it includes all your assets and properties. So, something which you can actually physically see. Or not every time you have to physically see, but mainly it classifies those accounts which represent your assets and properties. So, something like your buildings, laptops, at the same time, something which is you cannot physically see that, but you can still compute the value based on certain valuation measures. Something like goodwill or brand or your cash in hand. Now your cash accounts becomes a real account, or inventory, that is the goods that you have in your stock for purpose of sale or for manufacturing finished goods. So all these accounts get classified under the class of real accounts. The rule for real account is that debit what comes in and credit what goes out. So for example, if I have received a cash, I would debit my cash account. Or if I have given away cash, I would credit my cash account. And you can link it with our last discussion, is that when you actually credit any asset account, it means that value has actually reduced. This is the same principle explained in a different manner. So the rule is debit what comes in and credit what goes out. That is as far as real accounts are concerned. And the last category is that of nominal accounts. Now, what would a nominal account mean? Any account which represents any kind of income or expense is called as a nominal account. So, your sales or your interest, your discounts, salaries, purchases, and so on. Or there could be accounts like profit on sale of investment or loss on sale of investment. All of them, which in essence are talking of your income or expenses, are classified as nominal accounts. And the rule is again very simple: debit all expenses and credit all incomes. So on screen it actually needs a change. It should be credit all income. So debit expenses, credit all incomes and gains. So it's very simple to understand that there are only three types of main categories of accounts, and then along with that you have rule for each type of account, and that's all the accounting is all about. Alright, so you simply have to identify in a transaction what are the parties involved in that transaction. After understanding which parties are involved, which kinds of accounts are to be used, whether it's personal, real or nominal, and then based on these rules or the rules which we saw in our last table, you have to apply that rule and decide whether an account needs to be debited or an account needs to be credited. So let us understand this life cycle, and based on this example, let's actually try to account for few transactions, so which will clarify the concepts even better. So as far as life cycle is concerned, as a first step, a transaction would happen. We said that accounting is concerned with all the historical transactions. So unless a transaction happens, accounting will not start. So the first step has to be any kind of a transaction. Now, if this transaction is actually measurable in terms of money, then what we would pass is a journal entry. Alright, you may have also heard a term called JV, which is journal voucher, which is same as a journal entry. So what do I actually do at this step is to identify which accounts are to be debited and which accounts are to be credited along with their respective amounts. And from where would I get this data? Based on this nature of transactions. So that is the first step, wherein the moment I do a transaction, I account for this journal entry. Okay, wherein I would identify debit accounts and I would identify credit accounts. The next step is your ledger posting. So in those each specific accounts, and when I say accounts and ledger, it means the same thing. I would now summarize each of those accounts by posting these entries to the ledger. If you're not able to understand or visualize at this point of time, wait for the example on the next slide. But then essentially, if I were to say that, let's say if you look at your passbook or your bank statement, that is at this ledger posting state. All right. So from bank's perspective, it has done multiple transactions. First, it accounts for the journal entry through the journal entry, and then whatever is pertaining to you, that is your account, gets posted in your account. That is your ledger. And what you see is actually extract of books of accounts of a bank. So bank, whatever transactions were pertaining to you, they were summarized or posted in your ledger or your account, and they were presented to you in a form of passbook or a bank statement. So that's the next step called as ledger posting. Then we have a third step, which is not really accounting, I would say, but still traditionally this concept is still there, something called as a trial balance. This is equivalent to the term called as chart of accounts. Alright. What is this trial balance or chart of accounts? At the end of the period, what I do is I calculate balance in each of the account, and I check whether the total of debits and total of credits is actually matching with each other or not. So the only purpose is to find out balances in each account and check arithmetically whether the total of debits is matching with total of credits or not. So that's the trial balance. And last step is the finalization step, wherein based on this balances, I would prepare my profit and loss statement, I would prepare my balance sheet, and I would prepare my cash flow statement. So let us take one example and try to go through this entire cycle one by one. So we have a transaction on our screen which says that Virat starts a sports shop and appoints 2 employees. Now, would you account for this transaction? The answer is no, because whenever I start a shop and appoint employees, there is no monetary impact taking place. So as per money measurement concept, there would be no entry for this transaction. Next, he opens a bank account with Yes Bank and introduces 50,000 as his capital. So Virat goes to Yes Bank and opens a bank account in the name of business and invests 50,000 rupees in that bank account. Now let's go back to the concepts that we discussed so far. As far as business is concerned, Yes account would be personal account, Yes Bank account. On the other hand, who is giving the money? It is Virat who is giving the money, and while we will not call it as a Virat account, we will call it as capital account. So as per again our golden rule, debit the receiver, that is debit Yes Bank account, and credit the giver. So you may say that you may credit Virat account, and or because Virat is owner here, I will say that credit capital account. So how would I say that? Debit Yes Bank account and credit capital account. So that is how first a journal entry would be created. What is the next transaction? He purchases goods worth 10,000 rupees and pays salary of rupees 1,000 to his employees. So out of his 50,000 which were there in Yes Bank, he purchased goods worth rupees 10,000 and paid salary of 1,000 rupees to his employees. Now when we are talking of goods or stock or inventory, at why it is purchased? For sale. So there is some future benefit expected from this, from these goods. So till the point you have not sold those goods, till the time they are with you, it is your asset. Now as far as assets are concerned, we said that it is going to be your real account. Now if you recall our real account golden rule, it says that debit what comes in. So what has come in? Your inventory or your stock has come in. So you would debit inventory account by 10,000 rupees. And again, from where money has gone out? Yes Bank. And as I said, Yes Bank being a personal account, credit the giver, right? So a bank account that would be credited would be Yes Bank account. So I would debit inventory account by 10,000 and I would credit Yes Bank account by 10,000. And as you can see, a total of debit and total of credit would always be same. Similarly, now salary account will be expenditure for the company. That is why I would say debit all the expenses. So debit salary account, and from where money has gone out? Yes Bank. So credit the giver. So credit 1,000 rupees to Yes Bank account. That's how a transaction would be accounted for. Now next transaction, now out of this goods worth rupees 10,000, he sells goods costing 3,000 rupees for 4,500. So he makes a profit of 1,500 on this sale, and he receives this money by IMPs. So in a sense, he receives this money in his bank account, which is with Yes Bank. He sells those goods to Rohit. Also, he sells goods costing to 1,000 rupees for 1,500 rupees. So he would be making 500 rupees of profit on this transaction against a credit period of 30 days to Sachin. So there are two transactions which have taken place. One is sale of goods to Rohit for 4,500 and he has received the money immediately. On the other hand, there is a sale of goods to Sachin for 1,500 rupees. However, there is a credit period involved. So now recalling our accrual concept, in both the cases, Virat has actually performed his duties. He has already sold those goods. He has already delivered those goods. In one case, he has received the money. In another case, he has yet to receive a money. However, in both the cases, as per my accrual concept, I would recognize or I will account for this in a transaction as my income. Why? Because I have already performed my transaction, I have already performed my duties, and I have already obtained the right to collect this money. Correct? So on one hand, I would say that my bank balance has increased, right? So debit what comes in, that's the first part of it, wherein I would say that my Yes Bank account is debited by 4,500. I have actually received 4,500 in my bank account. Now something which is receivable from Sachin account would be a part of personal account. I can say customer account, I can say a debtor account, I can say accounts receivable, whatever it could be. The nomenclature does not really matter. What matters is the classification. So Sachin account would be personal account, and then I would say that the money is receivable from Sachin, right? So debit the receiver. That is why I would debit 1,500 rupees to Sachin's account. And this is my income, and as we said that if I want to increase my income, I need to credit my income account. I would credit total 6,000 rupees to my income account. So again, that's how my total of debits and total of credit matches with each other. So now my bank balance also increased. I debited my asset account. Sachin account would also be my asset account. I would debit that and I would show them as receivable from Sachin. And I will credit my income account and say that I have earned this income. At the same time, there would be another leg of the same transaction, is that in the transaction serial number 3, I accounted for this transaction saying that I have got an asset of 10,000 rupees. Now out of this 10,000, this 10,000 was recorded at cost. What is the cost? The rate at which I actually purchased those goods, right? So I accounted for this transaction at cost. Now I have actually sold some goods out of this inventory. And what is the cost of those goods? Is that 3,000 and 1,000. So total 4,000 worth of goods were being sold. So I need to reduce my asset because those many goods have actually gone out, and I need to account for this as my expenditure, right? So COGS here means cost of goods sold. You may also call it a consumption. You can use any kind of nomenclature, but what it essentially means is that now out of this 10,000 worth of goods, I have expensed out, or I have consumed, or I have used goods worth rupees 4,000. So my expenditure is by debiting my expense account, that is my COGS account, cost of goods sold, and by crediting my inventory account, I reduce inventory worth of rupees 4,000. Now why do we account for this transaction at cost? Is because you may see that as a trend, on both the occasions, Virat has actually made a profit by selling those goods. So obviously whatever is the balance inventory, it is expected that there would be certain profits by selling that inventory. But at this point of time, as per our conservatism concept, it says that your inventory balance should be as per your cost, and you should not account for any gains which are expected in future. So I increased my inventory balance by 10,000 rupees. Now I'm reducing it by 4,000 rupees. So my inventory balance would be at 6,000, which is still at cost. Now this 6,000 worth of inventory could be say sold for say 8,500 or 9,000 rupees. But still, based on my conservatism concept, in my balance sheet, I will report my inventory at 6,000 rupees only at cost and not add with the anticipated gain. So with this, we complete our first step, which is the most critical step in any kind of accounting, is to have a correct journal entry. Now this is the most difficult step, I would say. The rest of the steps are quite mechanical and simple. So once we have all those journal entries in place, we go to next step, which is a ledger. Now before I actually start explaining how do we actually post those entries, I request you to focus on the format. Now what you see on your screen as far as Yes Bank is concerned, this is called as a T format of accounting. Alright. So wherein left side represents debit and right side represents credit. Now you may also see some kinds of ledger format wherein they are not actually in T format, but then they would give you list of accounts one by one, and then you would have columns, one representing debit, one representing credit, something like this, what you see on left of your screen. While left, this part is not actually ledger, but you can have a similar format for ledger as well. Traditionally, the T format is used, but nowadays most of the software use this kind of a format, but both mean the same thing, or accounting with both the formats is similar to each other. There is no change. So let us understand how do we actually post those entries. So on the left hand side, I have picked up a set of transactions for which we pass journal entries on our last slide. Alright. So we had our Yes Bank account debited and capital account being credited. Then let us first understand what is need of having these kind of a ledger. If I were to summarize all those transactions wherein Yes Bank was involved, I cannot find out through my journal entries, because I do not know in what all entries was Yes Bank actually involved. So what do? Is I summarize all those entries at a single place wherein I can find all those entries pertaining to Yes Bank. So that's why you see a ledger with the name as Yes Bank account. Similarly, you have other ledgers for capital account, inventory account, salary account, and so on. So for all those accounts which you have debited or credited during your journal entry process, all would have its own ledger. Alright. So let us understand how do we actually post this transaction. As I said, the left hand side would represent debit side and the right hand side would represent a credit side. Let's take first entry. In first entry, we debited Yes Bank account. So we would have to record a transaction on debit side of Yes Bank account. Any transaction which is recorded on left side of Yes Bank account would mean that in that transaction, Yes Bank account was debited. Now what I need to record is that it was debited by Yes Bank account and credited by which account. That is the information that I am going to fill up here. So I would say that Yes Bank account was debited and the entry was credited to capital account by 50,000 rupees. So Yes Bank account debit side 50,000 rupees credited to capital account. Similarly, you have exactly mirror effect, or I can say contrary effect, in the capital account on credit side, wherein capital account was credited by 50,000 rupees by which account? By Yes Bank account. So that is how every entry would be posted. A debit side, on debit side, I would say that Yes Bank account debited by capital account 50,000, and for capital account on credit side, I would say that capital account was credited by 50,000 rupees and it was debited by Yes Bank account. That's how each entry would flow to respective accounts. Let's take next entry. So we debited inventory account. So for inventory account on debit side, we would say that inventory account was debited by 10,000 rupees and it was credited through Yes Bank account. Similarly, I will go to Yes Bank and on credit side, I will say that Yes Bank account was credited, the debit was in inventory account. That's how I start on summarizing transactions in each of the ledger. Same applies to the last entry as well. In salary account, on debit side, I write 1000. So salary account was debited by 1000 and credit went to Yes Bank account. The mirror effect would be in Yes Bank account, saying that Yes Bank account was credited, the debit can be found out in your salary account. That's how the ledger posting would happen. Let's continue with our example. Now, the next set of entries that we had was Yes Bank account was debited with 4,500 rupees and it was eventually credited by income account. So while we have a single figure as 6,000, if we were to break it up, 4,500 pertains to Yes Bank and Sachin 1,500 pertains to Sachin account. So that is why in Yes Bank account on debit side, we would say that Yes Bank account was debited 4,500. The credit could be found out in income account, that is here. Similarly, Sachin's account was debited by 1,500. The credit impact of it can be found out in the income account, and that's how we would replicate those entries in income account as well. Now I believe you would have understood the concept. So I have not represented both debit sides and credit side of this COGS and inventory account. I am simply posting as we did for our earlier transactions. So on debit side of COGS account, I would say that it was debited by 4,000. Credit can be found out in inventory account, and same in credit side of inventory account, I will write that it was debited by COGS account. The amount is 4,000. So now at journal entry stage, we actually identified which accounts are to be debited and which accounts are to be credited. Based on each of those transactions, we posted them in the relevant ledgers or relevant accounts. Right? So at the end of the period, what we would do is we accumulate all those transactions, each of the account, and compute a balance. So if we were to accumulate whatever we did so far as far as Yes Bank is concerned, initially we debited Yes Bank account with capital with 50,000 rupees. Then we inventory worth 10,000 rupees. We paid salary of 1,000 rupees, and then in bank account we received amount worth of 4,500. So if you can simply do the mathematical computation, you would find out that there is a balance of 43,500 in my Yes Bank account, something which I would carry forward to my next period. Right? So this is called as a balancing of a ledger, or this is called as a closing balance. All right. So for each of the account, now I am getting some questions in the chat. I will answer them at the question and answer session. Right. Let me just explain till the end. So I calculate balance for each of those accounts. Now I am going to talk about a confusing statement. All right. We said that if it's a asset account, then any debit would mean increase in value, right? So a debit balance in asset account would mean it's an asset, correct? So Yes Bank account, if you just simply forget our accounting and do a simple mathematics, that I totally received 54,500 in my account, out of which I paid 11,000. So essentially what I have in my account is 43,500, and that's my asset. So ideally it's a debit balance. Now a confusing part is that while this is a debit balance, when you close this account, it actually appears on your credit side, right? So even if it's a debit balance, it will, as far as closing balance is concerned, it appears on your credit side. Or if you were to take a format wherein you have one column stating accounts and then one column for debit and one column for credit, you will find this balance amount under the credit column. Does that mean that this is a credit balance? The answer is no. If you are talking of a closing balance, and if it is in credit side or in the credit column, it actually means it is a debit balance. All right. That is how we need to understand this. So your debits are more than credits, and that is why we call it as a debit balance. But then if you were to make sure that total of at at the end of my period is same, you will have to add up this amount on the credit side, and that's how you make debit equal to credit, right? So debits are higher than credits, we call it as a debit balance. But if it's a closing balance, then it is represented on a credit side. The same gets carry forward or brought forward to the next period as my opening balance. So the same balance which I had at the end of my last period becomes my opening balance for the next period. However, this time a debit balance is represented on debit side itself. Okay, so as far as opening balance is concerned, debit balance would be represented on debit side and credit balance would be represented on credit side. Whereas if we are talking of a closing balance, debit balance would be represented on credit side and credit balance would be represented on a debit side. So that's how you represent for each of the ledgers that we use so far. So without actually calculating for each of the ledgers, if I were to summarize what is the actual balance, then you would find something like this. So we took an example of Yes Bank account. We had a closing balance of 43,500 and it's actually a debit balance. So that is why in a trial balance or something which is called as a chart of accounts, you would find account name Yes Bank and balance as 43,500 under debit column, right? Similarly, we had inventory 6,000, salary 1,000, Sachin account receivable from Sachin 1,500, cost of goods sold 4,000, then initially capital which was introduced as 50,000 and income as my 6,000. And if you can see, total of debits 56,000 and total of credits is also 56,000. And why did it happen? Simply because we computed balance at in each of the ledgers to make sure that total of debits and credits is same, and we took all these balances to trial balance, and that's why we now have total of debits same as total of credit. Now there is one more thing to note here, is that trial balance as on some date. Alright, so far whenever we talk of a ledger would be capturing all those transactions. For example, this set of transactions that has happened during a certain period of time. Alright, or we are also going to discuss profit and loss account or profit and loss statement. It gives you all expenses and incomes for a given period, right? So these kinds of statements, this ledger account or profit and loss statement or even a cash flow statement, they are called as a period statement. What does it mean? They summarize transaction for some period, maybe a week, maybe a quarter, a month, a year, whatever it could be, and that will have to be mentioned. But then these are all period statements which give you details for the given period. Whereas trial balance, and we are also going to talk about balance sheet, they give you balance on a particular date, on a closure of a particular business day, something like 31st March. For those statements, we call them as a point statement. Why? Because they give you information on a specific point of time. So there are some statements which are period statements, which give you information for a month, a year, a quarter, whatever it could be. And there could be certain statements which give you information as on a particular specific date. Those are called as your point statements. Okay, so now we have our trial balance or chart of accounts ready. We have verified the arithmetical accuracy. The debits are and credits are matching. So then let's move towards the finalization step. So the key to finalization, we have two basic logics or rules, I can say. One is you identify all the personal and real accounts which are involved in all your trial balance, right? They will eventually go to the balance sheet, and all the nominal accounts, that is your income and expense, go to your profit and loss accounts. That is the simple key to remember how do we actually close these accounts. Okay, so you identify which is a personal account, which is a real account. Those accounts will have to go to balance sheet. Identify all those accounts which are in the nature of income or expense and transfer them to profit and loss account. But then the key question remains is to how do we identify what is asset, what is liability, what is income, what is expense. Obviously one way is based on the nature of account name you can identify. So when I say salary, one is able to understand that it is an expense account. right? So then we can have a simple thumb rule. So if your balance is a debit balance and if it needs to go to the balance sheet, it needs to go to the asset side. If your account has a debit balance and if it is required to go to P&L, that is if it is a nominal account, then it will be classified as an expenditure. Accordingly, if your account has a credit balance, so here for example we have capital account which has a credit balance and it is classified as a personal account. So it would be written under the head liabilities. Whereas if you have something in the nature of nominal account where you have income account here, which essentially needs to go to P&L, it would be classified as income. So the simple two-step calculation or logic is that you identify what is the type of account, and based on debit or credit balance, you can identify whether it should go to balance sheet, asset, liability, or under P&L, is it expense or income. So that's how we classify each account: yes bank personal account, inventory real account, salary nominal account, and so on and so forth. Against each type, based on personal and real, as I said, they would go to balance sheet BS, whereas nominal accounts would go to P&L, that is profit and loss statement or profit and loss account. If your account is going to go to balance sheet, if you have a debit balance, you would put it on the asset side, whereas if the account is going to go in balance sheet but has a credit balance, then it would go to liability side. If your account is a nominal account which is going to go to P&L, and if it has a debit balance, then it will go to the expense side of P&L. If it has a credit balance, it will go to the income side of P&L. That's as simple as that. You just need to identify type of account and determine based on debit or credit balance where it needs to be disclosed. So let's do it one by one. Right, so I just copied my trial balance to next page or chart of accounts, as you can see. Then I have profit and loss account for a period. As I said, it would be giving information for the entire period, whereas I have balance sheet as on a specific date. So P&L is my period statement, whereas balance sheet is my point statement. So let's take one by one. Yes bank, we would write it on asset side of balance sheet, right? Again, I would talk something about the format. Now, this is the conventional format in the T format that you see both P&L as well as balance sheet. However, regulations in various countries determine a specific format. So this is what is called as a vertical format. But what is adopted across the globe as of now is a horizontal format. All right, wherein first you write, as far as P&L is concerned, first you write all your incomes. Then below all your incomes, you note down all your expenses. Correct? As far as balance sheet is concerned, you first note down all your liabilities. Below all your liabilities, you note down all your assets. Now, some countries use T format, so that is your vertical format. Some countries use horizontal format. Also, as far as P&L and balance sheet are concerned, the regulations based on the industry of client may also vary. For example, for Indian companies, the Companies Act specifies a specific format in which the balance sheet or P&L has to be prepared, which is given in Companies Act. You may have heard Schedule 3 of Companies Act, which actually gives you a format. As far as banks are concerned, the Banking Regulation Act specifies the format in which this P&L and balance sheet should be disclosed. If insurance companies are there, the Insurance Related Act also specifies what should be the format of P&L and balance sheet. But then all these regulations essentially just tell you how the format should be. All the formats would have, so all the balance sheets in any format would have assets and liabilities, that is universal, and all profit and loss accounts or statement on profit or loss, whatever you could be the name, would have something for income and something for expense. So whatever be the format, accounting or disclosure remains the same. All right. So yes bank, we said debit balance goes to balance sheet, asset. Then you have inventory again in assets. Then salary being expenditure goes to expense side of profit and loss account. Then you have receivable from Sachin, which is 1500, again goes to asset side. then cost of goods sold on expenditure side, capital on liability side, and income on credit side of profit and loss account. All right. So far we have posted all those entries which were there in trial balance. So we took all the balances, we transferred them to profit and loss account for nominal accounts, and we disclosed all those balances of personal account and real account in a balance sheet. Now what is the next step? Now this P&L account we need to close like any other account. So again we compute what is the balance of this profit and loss account itself. So we calculate and understand that I had income of 6,000, I had expenditure of 5,000. So in essence, I made a profit which is 1,000 rupees. So when I say asterisk, it means a balancing figure. Maybe you would have noted this in our past slide as well. This asterisk would mean a balancing figure. That is the balance in that account. So I identified that I have made a profit of 1,000 rupees at the end of the period, and that's how my total of debits is 6,000 and total of credits is also 6,000. Now remembering our first discussion as far as business entity concept is there, now this profit is actually repayable to the owner, repayable to Virat. So that's why from business perspective, it is a liability, and I would add this amount under liabilities and I would add this as a part of capital. Right? And now if you take total of all the liabilities and all the assets, you would find out that the total is same, that is 51,000. And you may have heard the term the balance sheet is tallying. So when we say balance sheet is tallying, what does it mean? Total of liabilities and total of assets is same. So we closed P&L, that is we calculated profit or loss, we added profit to liabilities. Had it been a loss, we would have reduced it from capital. So we could have either shown it as asset or we could have shown as a negative figure on liability side, and then we would have computed the total. Okay. Now one more key thing to note here is that as far as trial balance was concerned, we had a total of 56,000 rupees. We had 6,000 rupees as P&L and 51,000 as balance sheet. Now do not try to say or compare that 51 plus 6 should be is 57, which is not tallying with trial balance. All right, that is not how it is supposed to work, because we can calculate, I mean there is a duplication as far as this 1,000 is concerned. Why? Because we have considered all those accounts in P&L and then only the net balance was considered in balance sheet. So do not try to correlate this 51 plus 6 with this 56. They are always going to be different to the extent of profit. Okay. So this is the basic financial statement closure. Now most of the small companies and banks are allowed to do the accounting or disclosure only till this extent. Obviously, they are also required to give a lot on what are the kinds of policies that they have adopted, what are the kinds of assumptions that they have made in their accounting policies, right? But then there is something also called as a cash flow statement. So why do we actually need this cash flow statement? Let us understand the logic of this cash flow statement. Why we need a cash flow statement is that because of accrual concept, we accounted for income and expenses whenever they actually were incurred. Whenever I used the electricity, I said that I have made an expenditure. Whenever I earned, so sold those goods, even though I have not received the money, I said that I have done my part, so I have this right. But was the actual cash received? The answer is no. So if I were to look at the accrual concept, then it does not give me what cash went in and what amount of cash went out and in what kinds of activities was this cash actually used. So that is where I use the cash flow statement. Now one way to say is that anyway, if I simply classify my bank account transactions or cash account transaction in a specific manner, then I would generate a cash flow statement. That is the one way of generating a cash flow statement. That is called as a direct method. So I take each transaction from my bank account and my cash account and I classify those as per the requirements. We are going to talk of different classifications now, 2-3 classifications are there. So I can simply classify each transaction, but most of the accounting standards talk about indirect method. What is this indirect method? This indirect method says that whatever is the profit or loss, if I calculate that, assuming all the transactions were recorded on recorded on cash basis. That is, whenever money was exchanged, only then I accounted for transactions. If I were to say that, then whatever is the profit should actually be lying in my bank balance, isn't it? However, because of accrual, I am calculating profit even though I have not received this money, or even if I have not paid this money. So let me start with whatever was the actual profit and then adjust for those transactions wherein I have accounted for the transaction even without receiving or paying money. That's how the indirect method would work. Now, this cash flow statement would have essentially two parts. Now, you will not find these two parts specifically divided as part A and part B. You will find it as a consolidated statement, but then the way to read could be in this manner. So, let me first explain part B of it. It says opening cash and cash equivalent. So, it does not only talk about cash that you actually physically hold, but anything which is as good as cash. Say, amount with your bank, which you can use as if it's a cash. So that is also included in your cash equivalents. So opening, I had 0 because on day 0 I had nothing, right? Then at the end of the period, I had amount of 43,500 in my Yes Bank account. So I would say that my closing cash and cash equivalents were 43,500. So in this entire period, what was the net change in cash and cash equivalent is that there was increase in my cash by 43,500 rupees. Why? Opening was 0 and closing is 43,500. Now the purpose of this cash flow, as I said, is to understand what was the source of this transaction and where all this money actually went in, right? So let us try to classify these transactions in various types of activity. Okay. So basically, as far as cash flow is concerned, the activities are classified in three parts. First is cash flow from operating activities, all those activities which are your core operation. All right. So as far as our example is concerned, buying and selling goods and anything related to buying and selling of goods would form part of operating activities. Why? Because we said that we are start a sports shop. So anything which is required to run that sports shop, purchase of inventory, payment of salary, and so on, would be classified under operating activities. Then the next set of activities is what we have as investing activity. So if the business has made certain kinds of investments or has withdrawn an amount from investment, we would classify those activities as investing activities. And the last part is cash flows from financing activities. So for running my business, I could have obtained my capital, I would have taken loan from my bank. So for financing or for funding those activities, I would have done certain kinds of transactions. So all those transactions get classified under financing activities. So these are the three key activities or the three classifications which are globally used: operating activities, investing activities, and financing activities. Okay. So as I said, under indirect method of cash flow preparation, we start with actual profit and loss account. So we said that we actually had a profit of 1,000 rupees, right? But then not all transactions were there wherein we actually paid or received the cash. So let us adjust them for whatever this profit or loss amount is there. So the next portion that you see is changes in working capital. Now whatever was required to run my business, and then if I compute the difference in my balance, I would identify changes in working capital. Let me just tell you these two items and I'll explain the logic as well. So it says increase or decrease in inventory or increase and decrease in receivables. So now when I purchased my inventory, this transaction was of a kind that while there was cash outflow, there was no impact on my profit or loss. Why? Because one cash, that is one asset reduced, my bank balance reduced, but then there was some other asset which actually increased. This had no impact on my profit and loss statement until I actually consumed that inventory. Correct? So that's why I need to adjust for that kind of a transaction. So it says on net basis, I have increased my inventory by rupees 6,000, which would mean that I have paid 6,000 rupees extra, impact of which is not covered in while computing this 1,000, and that is why I need to reduce my cash balance by 6,000 rupees. So there was increase in inventory and my cash balance went down by 6,000 rupees. Similarly, while calculating my profits of 1,000 rupees, I considered sale of 1,500 rupees, but I am yet to receive this money. So I have not actually received that cash. So that's why let me further reduce my cash balance by 1,500 rupees. So that's why we say that increase in assets would lead to reduction in cash balance, whereas increase in liabilities would lead to increase in my cash balance. Okay. So let's now calculate the subtotal. So from cash generated from operations, if I compute the net figure, I get negative 6,500. So while I am saying that during the period I had 43,500 as my net inflow, if I were to say from operating activities, my cash flow is actually negative, which means that I actually generated negative cash flow. That is, my cash outflow was more than cash inflow as far as my core operating activities are concerned. So while your P&L may say that you are in profit, your cash flow statement may say that as far as your core operations are concerned, you are actually may not be performing well because you have negative cash flow. You don't actually have cash from your operations. So that's the significance of a cash flow statement. As far as investing activity, we had no transaction in the nature of investment, so we would say 0. And then from financing activities, we had one transaction wherein we said that Virat introduced capital of 50,000 rupees. So that's why we would say introduction of capital 50,000 rupees under financing activities. So now if you calculate total of 50,000 and negative 6,500, you would understand that it is again same as 43,500. So the net change is 43,500. What is the breakup of that? Is 50,000 coming in from financing activities, 6,500 going out from operating activities, and that is how a cash flow statement gets prepared. It would give you how did cash come in and how did cash go out. Fine. So that's as far as our accounting life cycle is concerned. And whatever we have discussed so far, whatever is represented on the face of P&L or balance sheet is also called as an on the balance sheet item. So something which comes up on your P&L or balance sheet would be called as on balance sheet item. But there could be items which do not actually come on your balance sheet, are called as off balance sheet item. You may have also heard this term, off balance sheet items. So one of the key items in off balance sheet items is your contingent liabilities. Let us understand what these contingent liabilities are. So contingent liability, as the name itself suggests, is that it is a liability which is contingent on something. Correct? So it is a possible obligation, existence of which would be confirmed only by occurrence or non-occurrence of a future uncertain event. So the future event has to be uncertain, beyond the control. Correct? So for example, a bank guarantee issued by a bank on behalf of other person. So if the other person defaults, only then a bank would have to make a payment. Only then the bank would be liable. So the liability is contingent upon behavior of that person. If that person defaults, then liability is there. If the person does not default, the liability is not there. And that is why we classify this as a contingent liability. Or it could be a present obligation which may or may not require outflow of assets. So maybe as a manufacturer, I have given warranty of next 2 years. So I have already taken this obligation. If my part fails, then I will freely replace that part. So I will incur that expenditure on your behalf for next 2 years. Correct? But at this point, I do not know how many parts would actually fail and how many replacements will I have to do actually. Right? So though I have already taken the obligation, I am not yet sure how much outflow will have to be done and whether any outflow is actually required. So in that case also, I would classify this as a contingent liability. Or the third case could be the obligation is already identified. However, I am not able to measure it. So let's say a penalty case is going on against a company or against a bank, but then amount of penalty cannot be ascertained unless you have the result of that court case. So I know that I have to pay some liability or I have to pay some penalty, but today I don't know what is the amount. So that is why I am classifying this as a contingent liability. Correct? So as far as contingent liabilities are concerned, generally contra entries are passed, meaning if I am debiting one asset account, then I would correspondingly credit another liability account. So I increase my assets and I increase my liabilities as well. So the impact is nullified. Or if it relates to an income and expenditure, I would also increase my income, I would also increase my expenditure. So impact on profitability is nullified. So that's how this contingent liabilities are accounted for. Or in certain cases, the contingent liabilities may not at all be accounted for. So no journal entry, ledger and all this cycle is passed through. Only a disclosure is given in notes to accounts that these are the liabilities along with amounts wherever possible are there for the company. These are the contingent liabilities. So either they are disclosed by using contra entries or they are specifically disclosed in financial statements. Alright. So let's say if a bank issues a bank guarantee, it would pass an entry saying guarantee receivable account debit, because if at all the trigger event happens and the person defaults, bank would make payment, but it is recoverable from that customer. So it is amount receivable, so guarantee receivable. And then at the same time, if the person defaults, bank also has a liability towards the creditor, that is the person to whom this guarantee is given. So bank has a recoverable asset as well as it has payable liability. Both of them are contingent in nature. So I pass entry by increasing asset and also increasing my liability. So net effect is nullified. Just to give you an example, this is extract from financial statements of a bank, and you can go through the nature of items which are covered under contingent liabilities. So claims not acknowledged as debt. So somebody has put up a claim, but then the bank is yet to accept that and treat it as a payable liability. Right? Or your forward exchange contracts. So something, the result of which you do not know at this point of time. What could be the rate on the expiry date of this forward exchange contract? So this is a estimate of liability contingent upon what would be the actual rate on expiry date of contract. Or bank guarantees, your bill acceptances, endorsement and so on. So that is how they are actually disclosed in your financial statements. Next, we have one more concept that we have not discussed so far, is your clearing, wash or parking account. So the accounting treatment or accounting terminology remains the same. However, these types of accounts are used to temporarily park the transaction for a temporary period. Now there is something called as a suspense account as well. So we are not talking of a suspense account at this point of time. We will discuss what is this suspense account. But then the idea is to park a transaction in a temporary account for a temporary period. Why would I do this? Either the transaction inherently has two legs, one leg of which is happening today and maybe another leg may happen in future, or from control perspective, I may want to break the transaction in two legs. So on accounting of both legs of a transaction, parking account gets squared off. What does it mean? Let us understand with the help of an example. Correct? Let's take the last one, which is the simplest to understand, and then I will explain the first and second. So you would have seen on many documents that you, or maybe in most of purchase orders you would have seen that you have one location as a ship to location and you have one location as a bill to location. What does it mean? Let's say a company has a corporate office in Mumbai, whereas it has its plant in, let's say, Ahmedabad. So goods have to be shipped to Ahmedabad. However, the invoice needs to go to finance department, which sits in Mumbai. Correct? So my ship to location would be Ahmedabad, whereas bill to location would be Mumbai. Now when goods actually reach to Ahmedabad factory location, the stores keeper there would say that, okay, I have received the inventory, but then I am not the finance person. I do not know whether the bill is correct, whether the taxation, whether the rates, all that stuff. I am not aware whether this is correct. So let me do my part or my leg of transaction first. Let me increase my inventory balance and let me park the credit side of this entry in a parking account, right? So I would increase my inventory account, I will debit inventory account and credit a parking account. The nomenclature can be anything. So I can say inventory clearing account, or I can say stock clearing account, whatever it could be. So I would debit inventory account and credit clearing account. In finance, what I would do is that I would look at a bill. I will check whether the rates are correct. I will check whether the taxes are correctly applied. Now I know which or which supplier account is to be used. But then I don't know whether inventory was correctly received or not, because now I'm in Mumbai. I do not have idea about the inventory. So what I will do is that I will not debit inventory account. I will debit the clearing account. I will debit clearing account and I will credit my expenditure account or my party account, depending upon whether the amount is payable immediately or not. So we said that stores keeper would credit my parking account and finance team will debit my clearing account. So after both the legs have actually occurred, the parking account would have zero balance, and that is how these accounts are used. So one leg of transaction would create, say, a debit balance, and then the other leg would nullify that debit balance. If one leg creates credit balance, the other leg would nullify that credit balance. And at the end of the period, ideally, the parking account should have zero balance. Now let's say if there is a delay, or if goods have not yet reached but bill has already reached, or the other way around, your parking account can have some kind of a balance. But then a balance in parking account becomes your focus area, or as sort of a red flag that there is some anomaly in my accounting transactions, right? The other example could be your office transaction, wherein let's say ICICI Bank ATM is being used by SBI card holder, right? So how would SBI account for it, or ICICI account for it? At one stage, when ICICI pays this money, ICICI would uh, credit its cash account. Let's say because ICICI ATM was used, it would reduce its cash balance, and then it would park in the account, because it is not yet sure from which bank this money is actually receivable, or even from whether it is receivable from MasterCard or Visa. It may not really be aware. On the other side, as far as SBI is concerned, it will debit the customer's account, but the amount is yet to be claimed by the other side. So unless the amount is claimed by the other side, I will not put it as payable to Visa or MasterCard, right? So in that case, I may use this clearing account. So when my cards get swiped, I debit customer account, credit a parking account. When the other bank on the other side actually claims that money, then only I debit this parking account and credit the other bank's account. So that's how I square off this transaction. Similarly, payment gateway, somebody like your BillDesk or PayU, Atom. So they go on receiving money for their clients. So when they receive, they would debit their bank account and credit a clearing account. As per their cycle or as per their agreement with the customer, they will accumulate, maybe say for 2 days, 3 days, a week, whatever it could be, and there would be a one entry wherein all the amount would be actually transferred to the ultimate client. In these cases also, I can use the concept of clearing account. So first, I debit my bank account as a payment gateway company. I debit my bank account, credit a parking account, and whenever I am actually distributing that money to my end customers, I would debit my parking account and go on crediting my customer's account, or rather my bank account, right? So at the end of the period, my clearing, wash, or parking accounts gets nullified. Now suspense accounts also does the same thing. It is for temporary purpose, but then the reason of usage is different. Whenever there is a lack of details for a particular transaction, that's where you use the suspense account. For example, at a bank level, you have received money from another bank, but then you do not know for which of your customers this money has actually been received. So you account for receipt of that transaction, but as a bank, you are unable to credit any specific customer account because you do not have adequate details, or the details which you have received are incorrect. So in that case, I would park this amount in a suspense account. The moment I get all those details, I will take out this amount from suspense account and put it in the relevant customer's account. So again, at the end of the period, ideally, my suspense account balance should be 0. That's how your suspense account would work. And then we come to our last concept for today, as general ledger and sub ledger. So far we were using a word as ledger. Now we classify them into two parts, general ledger and sub ledger. Now why do we have this? Let us understand what is the purpose. Now when you have multiple accounts having similar characteristics, for example, you have hundreds of customers. For a bank, let's say it has hundreds of or thousands of customers having saving bank account, or as a company, I have too many customers or suppliers. Now, if I start disclosing each one of them in my balance sheet or profit and loss account, my P&L or balance sheet would run in thousands of pages, right? So then that's why I create one more concept. I create a summary account as general ledger GL and a sub ledger account, right? So then what I would say is I have one single customer account as a general ledger under which I would have account A, account B, account C and so on as sub ledger. So a sub ledger would be subset of your general ledger. And that's why I say that GLs are master or principal accounts which capture summary of a transaction, whereas SLs, that is sub-ledgers, record party-wise details. Now, I'm taking party-wise details because the examples which I've taken pertain to a specific person. Now, you may also have a case wherein a company has hundreds of different assets like plant and machinery, thousands of laptops and so on. So then I create a single general ledger account as laptop. Within that, serial number wise, I create multiple sub-ledgers so that I still have identification to a specific laptop. But as far as balance sheet is concerned, I will only report the summary figure at GL level and not at sub-ledger level. All right. But then, as we said that the sub-ledger is going to be subset or breakup of this GL, the next point we need to note is that the total of sub-ledger balances has to be always equal to general ledger balance. Let's understand this with the help of an example. So now assume you are a bank and then you have thousands of saving bank account holders. At the end of the month, you decide to credit a savings bank account interest. So for you, the interest is going to be expenditure. So the entries should be actually the other way around. The debit and credit should be the other way around, but let's focus on the concept. Is that I would use the saving control as GL, right? And interest on expenditure, interest on savings bank account as my nominal account. Here, I am not naming any of the account holder. I am simply using the saving control account as single GL account with, let's say, GL code 1001. All right. And this is the total amount of transaction. On the contrary, when I'm using sub-ledgers, I would say that John saving bank account, Jane saving bank account, Jason saving bank account, and so on. Right? So then GL code would be, let's say, 10011, 10012, 2, and so on. So I have a GL saving control account under which I have multiple sub-ledgers. So when I'm going to report in my P&L or balance sheet, I will only report this saving control account and not all the sub-ledgers. Now, a software or the application may be configured in such a manner that either I pass this as a one entry and this as a separate entry, and you would find both the entries in saving control account, and at the end of the period, saving control would have zero balance. Alternatively, you can actually create this as a breakup or as a sub-ledger within the GL itself, wherein when you pass this entry, you are allowed to choose the options from the available sub-ledgers. You pass a single entry and the sub-ledger amount also gets stored while passing the single entry itself. In this case, what we said, the total of sub-ledgers would be equivalent to GL balance. That's how it would work. So GL would be your master account, whereas your sub-ledgers would be subset of each one of them, giving you detailed breakup of your GL. All right. So with this, we complete our today's agenda. Let me spend just a couple of minutes for explaining what all are the MVLCO programs as far as BFSI is concerned, and then we will have a small question and answer session. So as you are aware that MVLCO has its own payment certifications which are widely accepted. The key ones are international payment systems, which cover all your payment systems like RTGS, NEFT, IMPS, and so on across the globe. It also focuses on US and SEPA region. Apart from that, it also focuses on Canada as well. Then you have a specific course on cards, which talks about your debit credit cards, the EMV, and the near field communication, that is the NFC cards as well. A course specifically on payment messaging for SWIFT and ISO 20022, and on payment processing, that is your all payment engines and all the internal softwares of a bank. I'll just give you a minute to read the kinds of courses, and then we will start off with question and answer session. So you can actually start typing your questions in the chat pane. Okay, so I'll take questions which have been already there in the chat pane. So one question was there saying, can you please explain on MTM example in terms of derivatives market? Okay. So let's take a case of a forward or a future contract. All right. What a forward or future contract would mean is that, let's say we do a transaction for, let's say, dollar and INR rate. All right. So today, while the rate is, let's say, 65 rupees per dollar, I say that after 1 month, I am ready to buy dollars at, say, 70 rupees per rupee. Sorry, 70 rupees per dollar. This is the rate that I have fixed today itself, and expiry would be at the end of 1 month. Correct? Now, mark to market, what do I have to do? Is that on a daily basis, I will go on checking what is the actual dollar rate. What I have agreed for is 70 rupees per dollar. Now, today it is at 65. Let's say tomorrow it actually goes at 66. Now, because I have agreed to buy at 70 and today's end of the day market rate comes out to be 66, potentially I will have loss of 4 rupees. So today itself, I will have to book this loss at rupees 4 for every dollar. Tomorrow, let's say dollar rate moves from 66 to 67. Now, I have already booked a loss of 4 rupees, which was difference between 70 and 66. So now my transaction valuation is at 66 rupees. I have one more dollar gain. Today, I will book gain of that 1 more rupee. All right. So now after 67, let's say it moves to 69 on next day. Then I will book profit of 2 rupees on the next day. Let's say it moves further to 71. If I were to apply conservatism concept, I would restrict my gain to up to 70 rupees only, right? However, because now I am using the MTM concept, I will also book this profit of additional 1 rupee and value this transaction now at 71 rupees. Now let's say if it moves to 75, I will further account for this additional gain of 5 rupees. That's how an MTM would work in derivatives market. So you compute day gain or loss at the end of each day, whether it is realized or not, be it notional, you still account for it if your securities fall under MTM category. The next question is whether I will be sharing the PPT. What I would suggest is that the session is actually getting recorded. Give me a couple of days for editing. I will share the entire session on the YouTube itself and ask our training team to share link of this video to you so that you get PPT as well as whatever discussion that we had. So last time, about a couple of weeks back, we had a seminar. I mean, many of you would have joined. Swift for trade finance. That video is already there on YouTube. I believe there is some audio issue in initial part, but then it is on YouTube and you can actually view that along with the PPT. All right. So I believe all the questions are answered. So let me thank every one of you for your participation. I hope you liked the session. Please let us know your feedback, and please get back to our training team for any inquiries or any concerns or any response or any feedback that you have for the session. So thanks all of you. You have my contact on the slide, as well as you have contact details of our training team, and you please visit our website for all other courses and all the other information. Thank you. Thanks a lot.